the United States carries a financial obligation that exceeds $37 trillion. To put that number in perspective, it surpasses the total economic output that the entire world generated in a single year just 20 years ago. More debt than any civilization has accumulated across all of recorded history. And here's what remains almost entirely absent from mainstream financial discourse. The government has no intention of repaying this obligation through conventional channels. They're constructing an erasure mechanism, not through what people typically imagine, defaulting on their obligations, implementing severe spending restrictions, or raising taxes to unbearable levels, but through systematic devaluation. This involves a deliberate, methodical, and largely invisible transfer of purchasing power away from everyone who holds and depends on dollars. The tool executing this transfer isn't something most people associate with government policy at all. It's cryptocurrency and precious metals. Right now, the US government is orchestrating perhaps the most elaborate debt elimination strategy ever conceived. The strategy itself operates through a process called asset revaluation. The government accumulates strategic holdings in Bitcoin and gold, keeps these positions quiet, then revalues those assets at multiples far higher than their current market prices. That revaluation creates trillions in new balance sheet value. That new value theoretically offsets debt that's mathematically impossible to pay through earnings or taxation. But here's where this becomes genuinely frightening for anyone holding dollars. When assets get revalued upward, the currency they're measured against must devalue downward. This is simultaneous, the same mechanism. Every dollar sitting in your account, every bond certificate in your possession, every savings vehicle denominated in dollars loses its purchasing power. You experience a form of legal confiscation. Quiet, comprehensive, completely legal. Most people won't recognize it happened until their dollars can no longer purchase what they purchased last year. This mechanism didn't originate yesterday or last year. It has a template, and that template was executed with stunning precision during one of America's most desperate economic moments. In 1933, the United States faced a cascading financial catastrophe. The aftermath of World War I had left the government drowning in debt. The Great Depression was simultaneously destroying the real economy, eliminating jobs, collapsing businesses, and evaporating wealth across every segment of society. Deflation, the opposite of inflation, was compressing prices downward, which sounds beneficial until you realize it makes debt harder to service, because future dollars are worth more than current dollars. The government's debt to GDP ratio had climbed to 40% and continued rising. The situation demanded a radical intervention, something so unconventional that it required executive authority to execute it. President Franklin Roosevelt understood this reality. He recognized that the federal government possessed a tool that ordinary households don't have: the ability to redefine currency itself. That's not poetic language. That's literal governmental power. When you owe money as an individual, you must repay it with actual economic value. You work additional hours, you sell possessions, you reduce your spending. Governments operate under different rules. They control the printing press. More importantly, they control the definitions. They can alter what a dollar represents. They can change what their assets are worth on the official ledger. They can make massive debt obligations simply evaporate without ever paying principal or interest through taxation. Roosevelt decided to deploy this power. In 1933, he issued Executive Order 6102, which made it illegal for American citizens to own gold. Not just difficult, illegal. Citizens were compelled to surrender their gold holdings to the government. The official purchase price was $20.67 per ounce, the price that had existed since 1879, 54 consecutive years of identical pricing. The dollar itself was defined by law as 1/20th of an ounce of gold. This was the gold standard. Your dollar was literally a contractual claim on physical gold stored in vaults. Most Americans complied with the order. They turned in their gold, received dollars at $20.67 per ounce, and assumed that was the end of the matter. What happened next reveals the true mechanism. After the government completed the confiscation and held most of the nation's gold in their vaults, Roosevelt simply changed the price. In 1934, he announced the new official gold valuation, $35 per ounce, a 69% increase. Overnight, the government's gold reserves, which had been valued at approximately $4 billion under the old pricing, were now worth $6.8 billion under the new pricing. They manufactured $2.8 billion in pure accounting value without producing anything, without generating any wealth, simply by redefining what an ounce of gold was worth. But the debt the U.S. government owed, the bonds, the obligations, the financial commitments, remained denominated in dollars. Those dollars were now worth substantially less relative to gold. Before the revaluation, the government's debt burden represented 40% of the nation's economic output. After the revaluation proceeded and the inflation it triggered spread through the economy, within 5 years, that same debt burden had fallen to 25% of GDP. They erased 15 percentage points of debt to GDP ratio, not through payment, through currency destruction. The Americans who had surrendered their gold at $20.67 per ounce watched helplessly as that same gold became worth $35. Yet they couldn't purchase it back. The law still prohibited private gold ownership. They were trapped holding devalued dollars while their government applied their confiscated gold to eliminate debt burdens. The purchasing power of an average American's savings declined by approximately 40% over the next decade as inflation rippled through the economy, the invisible cost of the government's debt solution. This isn't ancient history that belongs in dusty economic textbooks. This is the operational playbook. This is the blueprint. And the United States government is executing the identical strategy again right now, except they've had 90 years to refine the mechanism and make it far more sophisticated. The pieces are moving into position precisely as I'm speaking, and once this revaluation executes, there's no reversal mechanism, no way to undo the damage or recover what's been lost. Everything changes in the window between now and 2027. The current debt situation has metastasized beyond anything that existed in 1933. The United States currently carries $37 trillion in outstanding obligations. The debt-to-GDP ratio stands at 132%, higher than any point in American history, with a single exception: World War II. Just the annual interest payment on that debt reached $1.2 trillion. To contextualize that number, the defense budget is lower. Medicare spending is lower. Only Social Security exceeds it. These are the three largest expenditure categories in the federal budget, and interest payments now rival them. Interest rates remain elevated. If rates maintain at 5%, projections show interest payments climbing to $1.8 trillion annually by 2027. That represents 6% of the entire GDP, consumed purely by interest, not reducing principal, just servicing the accumulated debt. Every person with economic training, every analyst, every Treasury official, every Federal Reserve policymaker, they've all run the numbers. The consensus is unanimous. There exists no scenario where this debt gets repaid through conventional mechanisms. You cannot raise enough taxation. GDP growth cannot outpace debt growth when debt compounds faster than economic expansion. Spending cuts cannot be severe enough when interest alone consumes such an enormous portion of the budget. There is precisely one option remaining: devaluation. Strategic, calculated, deliberate currency devaluation. But here's the complication. If the government simply prints enormous quantities of money to service debt, people see it immediately. The inflation becomes obvious. The dollar crashes. International confidence collapses. Trading partners lose trust. Creditors demand higher yields. The entire financial system enters crisis mode within weeks. The government needs a more elegant method, a strategy that appears legitimate, a mechanism that sounds like wise policy rather than currency destruction, a framework that doesn't look like theft. Enter Bitcoin and gold as strategic reserve assets. On January 23, 2025, President Trump signed an executive order establishing what the administration called a strategic Bitcoin reserve. The order explicitly directs the Treasury Department to acquire and maintain Bitcoin as a strategic asset, paralleling how the Strategic Petroleum Reserve holds oil reserves for national security purposes. The public framing emphasizes innovation, positioning America as a global leader in digital assets, preventing the nation from falling behind China and other countries in cryptocurrency adoption, protecting American technological innovation in the financial sector. That's the narrative presented to the public. That's what appears in press releases. That's what politicians reference in speeches. The actual mechanism operates quite differently. The U.S. government currently holds approximately 210,000 Bitcoin, accumulated through criminal asset seizures over decades. The Silk Road prosecution alone yielded substantial Bitcoin holdings. The Bitfinex hack recovery brought more. Various ransomware prosecutions added to the stash. At current market prices hovering around $100,000 per Bitcoin, this holding represents roughly $21 billion in value. Not insignificant, but mathematically trivial against a $37 trillion debt problem. However, the executive order doesn't merely direct the Treasury to hold existing Bitcoin. It authorizes the acquisition of substantially more Bitcoin. Senator Cynthia Lummis, who introduced the Bitcoin Act, receiving bipartisan support, proposed acquiring 1 million Bitcoin over a 5-year accumulation period. At current market prices, that acquisition would cost approximately $100 billion. But the government isn't purchasing Bitcoin on open markets in ways that would drive prices upward and alert everyone to the strategy. They're acquiring it through quieter mechanisms, seizing it from ongoing criminal investigations, accepting it as payment when crypto companies face regulatory fines and settlements, potentially mining it using government-owned energy infrastructure at military facilities. The accumulation happens without announcement, without public disclosure, without transparency. Here's where the revaluation mechanism activates. Imagine the government successfully acquires 1 million Bitcoin over the next 3 years at an average acquisition cost of approximately $120,000 per Bitcoin. That totals $120 billion in accumulated acquisition costs. They accomplish this quietly, accumulating through the channels I described, never announcing their total holdings, never making large market purchases that would trigger price movements and media attention. By 2028, they possess 1 million Bitcoin. The financial markets don't actually know the government's total position. They can estimate, they can guess, but they don't know with certainty. Then the government makes a dramatic announcement. The United States Strategic Bitcoin Reserve is now operational. The U.S. government holds 1 million Bitcoin as a strategic reserve asset, secured, backed by the full faith and credit of the United States government. But here's the crucial component. They don't value it at current market prices. They value it at what they call strategic reserve valuation. Not $100,000 per Bitcoin. Not $200,000 per Bitcoin. They value it at $1 million per Bitcoin. A tenfold revaluation overnight. Their 1 million Bitcoin, which cost $120 billion to acquire, is suddenly valued at $1 trillion on the government's balance sheet. They manufactured $880 billion in pure balance sheet assets simply by changing how they account for an asset they already owned. But this transcends accounting fiction. When the US government, the largest holder of Bitcoin in the world, by an enormous margin, officially declares that Bitcoin equals $1 million per coin and backs that declaration with the full faith and credit and policy authority of the United States, the market follows. Not because Bitcoin suddenly has intrinsic value worth $1 million, but because the world's largest economy, backed by the world's largest military, the world's reserve currency, is now using that Bitcoin at that price. Bitcoin doesn't reach $1 million overnight. Markets don't move that rapidly. But it escalates to 300,000, then 500,000, then 800,000 over the following 12 to 18 months, moving progressively toward the official government valuation. Close enough that the mathematics work. The government's balance sheet accounting becomes defensible. Simultaneously, something else happens, something critical. The dollar collapses. If Bitcoin, a digital asset with zero intrinsic value, except what people assign to it, is suddenly worth $1 million, that means the currency measuring Bitcoin has lost value. Dramatically, the revaluation of Bitcoin upward and the devaluation of the dollar downward are identical events, viewed from different perspectives. They're simultaneous. They're inverse. They're two sides of the same mechanism. But Bitcoin alone isn't sufficient for what the government needs to accomplish. This requires a two-pronged strategy. Bitcoin addresses the future of the financial system. Gold addresses the past. The U.S. government officially maintains 8,133 tons of gold, approximately 261 million ounces. At current market prices of roughly $800 per ounce, this holding possesses a market value of approximately $731 billion. Substantial wealth, certainly, but mathematically insufficient to make meaningful impact against a $37 trillion debt burden. Yet here's what most people don't realize. The U.S. government doesn't value this gold at market prices. On the official government books, on the Treasury Department's balance sheet, gold is valued at $420 per ounce. That valuation was established in 1973 and has remained frozen ever since. 52 years of identical accounting value, while the real market price fluctuated wildly. On the books, the U.S. gold reserve is worth $11 billion, not $731 billion. 11 billion. The government holds an asset worth $750 billion and officially values it at 1% of that amount. This is deliberately constructed. This is intentional. This gap exists precisely so the government maintains room to revalue upward when the moment arrives. When the revaluation occurs, and it will, the U.S. government announces a fundamental reassessment of its gold holdings, not a revaluation to current market prices. Higher. They declare that for purposes of the strategic reserve and debt backing mechanisms, gold will be valued at $20,000 per ounce, not $20,800. 20,000. Why that specific number? Because that's the valuation that makes the mathematical equation work. At $20,000 per ounce, the U.S. gold reserves shift from $11 billion on the books to $5.2 trillion in balance sheet value, from $11 billion to $5.2 trillion. They created $5.2 trillion in accounting assets simply by revaluing an asset they already owned, that they already held in their vaults, that required zero additional work or production. Combine the two mechanisms. 1 million Bitcoin at $1 million each equals $1 trillion. 261 million ounces of gold at $20,000 per ounce equals $5.2 trillion. The total new balance sheet value from this dual revaluation strategy is $6.2 trillion. $6.2 trillion in assets that can technically offset government debt, not pay it off, not service it, but offset it on paper, making the debt to GDP ratio appear more manageable, making the government's balance sheet appear solvent, making the government appear financially stable and capable. The debt remains $37 trillion nominally, but suddenly the government can point to $6.2 trillion in strategic assets and claim the net debt burden is lower. But again, this extends beyond accounting sleight of hand. Once the U.S. government officially revalues gold to $20,000 per ounce and announces this valuation with policy backing, market repricing follows. The largest gold holder on the planet, backed by the world's most powerful military and economic system, declares gold is worth $20,000. The market listens. Gold doesn't move to $20,000 overnight. Markets exhibit friction, resistance, volatility, but it escalates to $5,000, then $8,000, then $12,000 over the subsequent years, tracking progressively toward the official revaluation. And as both assets, Bitcoin moving toward 1 million, gold moving toward 20,000, climb toward these revaluations, the dollar simultaneously collapses in purchasing power. When gold appreciated from $2,800 to $20,000, the dollar lost 85% of its value relative to gold. When Bitcoin appreciates from $100,000 to $1,000, the dollar lost 90% of its value relative to Bitcoin. The average person doesn't conceptualize wealth in terms of gold ounces or Bitcoin holdings. They think about groceries, gasoline, rent, utilities, food, housing costs. Those prices explode upward. The evidence that this strategy is already executing isn't buried in declassified documents or leaked government memos. It's visible in plain sight, in signed executive orders, in introduced legislation, in public policy moves, in central bank behavior, in international repositioning. It's everywhere if you examine it. In December 2024, Senator Cynthia Lummis introduced the Bitcoin Act. The legislation proposes that the United States acquire 1 million Bitcoin over 5 years, maintain the holdings for a minimum of 20 years, and utilize this accumulation as a strategic reserve asset equivalent to the petroleum reserve or military capabilities. The bill has received bipartisan support, Republicans and Democrats both signing on. Why? Because both parties understand the debt is mathematically unpayable. Both parties comprehend that devaluation is the only remaining option. Both parties would prefer to transfer wealth from savers to the government, rather than implement spending cuts or tax increases that destroy political capital. This legislation represents the formal framework for Bitcoin revaluation. It's not about fostering technological innovation or cryptocurrency adoption. It's about creating a mechanism for debt elimination through asset revaluation. In January 2025, President Trump signed the executive order establishing the Strategic Bitcoin Reserve. This order grants the Treasury Department authority to acquire Bitcoin holdings. It directs federal agencies to develop policies supporting digital assets and cryptocurrency infrastructure. It positions Bitcoin within the context of national security, elevating it beyond technological discussion into the realm of state power. This executive action is the operational execution of what the legislation proposed. The bill established the concept. The executive order activates it. The government isn't waiting for complete congressional alignment. They're moving now, establishing facts on the ground, accumulating assets, and building the legal framework simultaneously. On the gold side, there's been consistent discussion about returning to a gold-backed currency system. Not a complete return to the classical gold standard where every dollar is redeemable for a fixed amount of gold, but a partial backing arrangement where the dollar is backed by a percentage of the nation's gold reserves. This sounds fiscally conservative. It sounds responsible. It sounds like sound money principles that appeal to people concerned about currency stability and government monetary discipline. It's masterful framing, because what it really is the setup for gold revaluation. You cannot credibly back the dollar with gold at current market prices. The mathematics don't work. The M2 money supply, cash and near cash assets in circulation, is approximately $21 trillion. The U.S. holds $731 billion in gold at current market prices. That's 3.5% backing of the money supply. You cannot establish credibility for gold-backed currency when only 3.5% of circulating money is backed by gold. The public doesn't accept that as backing. International trading partners don't accept that. But if you revalue gold to $20,000 per ounce, suddenly you've created $5.2 trillion in gold reserves. That's 25% backing of M2. Now you can credibly claim the dollar is backed by gold. You can market it as a return to sound money principles, as a restoration of fiscal responsibility, as a conservative policy that appeals to people who prefer hard money backing. What you've actually accomplished is revalued gold sevenfold and destroyed 85% of the dollar's purchasing power relative to that gold. It's confiscation marketed as financial responsibility. This strategy requires international alignment because gold and Bitcoin trade globally. A single nation can't revalue assets that have worldwide markets without coordination, implicit or explicit. The U.S. is positioning this revaluation to occur around the same time frame as other major economies face identical debt crises. The BRICS nations, Brazil, Russia, India, China, South Africa, have discussed gold-backed currency creation for years. They've expressed fatigue with dollar dominance. They've articulated frustration with American monetary policy exporting inflation to their economies. They want an alternative to dollar hegemony. Consequently, they've been systematically accumulating gold reserves at record rates. China officially holds 2,300 tons of gold. Analysts estimate the real number, including holdings through state-owned enterprises and unconventional channels, exceeds 4,000 to 6,000 tons. Russia maintains 2,300 tons officially. India possesses 840 tons and continuously purchases more. These nations are preparing for a monetary reset. They're accumulating hard assets that will retain value when fiat currencies experience collapse. When the U.S. revalues gold at $20,000 per ounce, the revaluation immediately affects gold markets globally because gold is a fungible commodity traded internationally. When the U.S. declares gold at $20,000, when China simultaneously recognizes gold at $18,000, when Russia values gold at $22,000, the global market price settles within that range. Everyone's gold reserves get revalued simultaneously. Everyone's government debt gets devalued simultaneously. It appears uncoordinated, spontaneous, market-driven. It's actually a globally synchronized reset that solves every major government's unpayable debt problem simultaneously. Every government has the identical problem: debt that cannot be paid through traditional mechanisms. Every government has the identical solution: devaluation through hard asset revaluation. The coordination isn't explicit. There are no secret meetings finalizing synchronized action. It's implicit alignment, convergence based on identical incentives and identical constraints. The timeline is visible for those examining the evidence. 2025 represents the accumulation phase. The U.S. government acquires Bitcoin through seizures, settlements, and strategic purchases executed quietly, without announcing totals, without triggering market awareness. Gold narratives build. Policymakers discuss gold backing, sound money, strategic reserves, conditioning the public to accept the concept. Central banks worldwide accelerate gold purchases. In 2022 and 2023, central banks bought over 2,000 tons of gold, the highest volume since 1950. These aren't casual purchases. These are institutions with intelligence operations, with economic advisors, with inside information, preparing for what they foresee. 2026 represents the crisis phase. The debt ceiling fight becomes genuinely severe. The U.S. government faces potential default or shutdown. The bond market exhibits stress, yields spike, confidence wavers, credit rating agencies issue warnings. The government faces a legitimacy crisis, not manufactured, real, that creates justification for extraordinary measures. In times of genuine crisis, governments can implement policies that would be politically impossible during normal times. The crisis becomes the rationale. 2027 represents the revaluation phase. The government announces the strategic Bitcoin reserve is fully operational. We hold 1 million Bitcoin. We're valuing it at $1 million per coin for balance sheet purposes. The announcement reframes Bitcoin from a speculative asset to a state strategic tool. Simultaneously, they announce a return to gold-backed currency. The dollar will be partially backed by gold. Gold is officially revalued to $20,000 per ounce for reserve purposes. This is marketed as stabilizing the currency, restoring confidence, ensuring American financial leadership for the next century. The public accepts it because it sounds strong. It sounds responsible. It sounds like the opposite of the irresponsible money printing that caused inflation in earlier years. What's actually happening? Bitcoin escalates from $100,000 to $1 million over 12 to 18 months. Gold escalates from $2,000 to $800 to $20,000 over the same period. The dollar loses 70% of its purchasing power in real terms. Inflation doesn't moderate to 2 or 3% annually. It explodes to 30, possibly 50% in the first year alone. Food prices triple. Energy costs quadruple. Housing prices nominally double, but in real terms collapse because nobody can afford them at the new wages. The economy enters stagflation. High inflation combined with low or negative growth. Unemployment climbs to 8 to 10%. The middle class experiences comprehensive destruction. The wealth that took decades to accumulate evaporates in months. But the debt, the government's debt, the national debt, is erased. Nominally, it remains $37 trillion. In real terms, adjusted for the inflation the government intentionally created, it's worth $12 trillion. The government eliminated $25 trillion in real debt burden. Mission accomplished. The government survives. Creditors are destroyed. Savers are devastated. And it's all legal. All policy. All justified as necessary to preserve American financial strength and global leadership. Let me show you exactly who wins and who loses in this revaluation. The winners are obvious and substantial. The U.S. government eliminates $25 trillion in real debt burden without defaulting, without acknowledging what occurred, without taking political responsibility. Politicians avoid the catastrophic political consequences of spending cuts or tax increases. The Federal Reserve maintains control over the monetary system, preserving institutional power through the transition. Early Bitcoin holders, those who purchased Bitcoin at $30,000 or $40,000, witness their holdings appreciate to $1 million, a 25 to 33-fold multiplication of wealth. Early gold holders, those who purchased gold when it traded at $800 per ounce, watch their holdings appreciate to $20,000, a 25-fold multiplication. But this only works if you hold through the volatility without capitulating. Foreign governments with gold reserves, China, Russia, India, Brazil, benefit identically. Their gold gets revalued. Their government debt gets devalued. They solve their own debt crises using the same mechanism. The wealthy, the people with assets, real estate, stocks, businesses, equity holdings, watch those assets inflate in nominal terms. In real dollars, they may lose value. But in absolute quantity of currency, they become more expensive, which makes them accessible only to people who understood the reset was coming and positioned accordingly. Now, the losers. The middle class, the people with modest savings, regular dollar income, regular employment. experience comprehensive destruction. Their savings accounts evaporate in purchasing power. What $100,000 could purchase 3 years prior now requires $300,000. Retirees on fixed incomes watch their purchasing power collapse simultaneously with their bond valuations. Bondholders, anyone holding U.S. Treasuries, government debt, are repaid in devalued dollars. A bond purchased at face value of $1,000 is repaid with dollars worth $300 in real terms. You lose 70% in real terms, despite receiving your nominal principal back. Pension funds, which hold massive quantities of government bonds, watch the real value of their assets collapse, triggering pension reductions and benefit cuts. Workers experience wage suppression. Their nominal wages might increase 5 to 10% annually, but inflation runs 30 to 50%, so real wages fall 40 to 50%. Living standards collapse. Renters watch landlords raise rents to match inflation, but their wages don't keep pace. People get priced out of housing. Homelessness explodes. Small businesses can't raise prices fast enough to cover their rising costs. Their margins collapse. Business failures spike. The American dream, home ownership, retirement security, generational wealth building, dies because the currency that denominated that dream is destroyed. This isn't hyperbole. This isn't speculation. This is the mathematical outcome of the strategy, and it's happened repeatedly throughout history. Weimar Germany, 1920s. The government couldn't pay war reparations, so they printed money. The mark collapsed. Hyperinflation destroyed the middle class. Government debt disappeared. Argentina, multiple times across different decades. The 1980s, 1990s, 2000s. The government couldn't pay debt, so they devalued the peso. Savings evaporated. Debt disappeared. Zimbabwe, 2000s. The government printed money to cover deficits. The Zimbabwe dollar became worthless. People carried wheelbarrows of cash to purchase bread. Government debt was gone. Venezuela, 2010s. The government printed bolivars to fund spending. Hyperinflation destroyed the economy. The debt burden was eliminated. The pattern is universal, repeating across different nations, different time periods, different political systems. Government becomes over-indebted. Government devalues currency. Savers and creditors lose everything. Government survives. The U.S. is following the identical script, just with more sophisticated branding, more advanced financial engineering, more complex mechanisms, more plausible deniability. They're not calling it money printing. They're calling it strategic reserve revaluation. They're not calling it currency debasement. They're calling it gold-backed dollar restoration. They're not calling it theft. They're calling it necessary policy to preserve American financial stability and prevent catastrophic default. The outcome is identical. You lose. They win. Now, what you're about to hear is not financial advice. It's a survival framework. Because once the revaluation executes, it's finished. There is no reversal. There is no recovery for those unprepared. The decisions you make over the next 12 to 24 months will determine whether you preserve wealth through this transition or lose everything. The window is closing, not metaphorically. Actually, the timeline is visible. The machinery is in motion. You require a concrete action protocol. Here it is. Week 1. Open a precious metals account. Start purchasing physical gold. Not gold ETFs, those are paper claims on gold held by institutions you don't control. Not gold mining stocks. Those are equity exposure to mining companies with their own operational risks. Physical gold that you personally possess. Coins, bars, stored securely in locations you control or trust. Gold has functioned as a store of value for 5,000 years across every civilization, every currency system, every economic collapse. When paper currencies evaporate, gold retains purchasing power. Start with 1 ounce minimum if your financial situation is constrained. Scale upward based on your net worth. The target allocation is 10 to 20% of your total net worth in physical gold. If you have $500,000 in net worth, you should target $50,000 to $100,000 in physical gold by the time the revaluation occurs. Week 2. Open a Bitcoin account. Purchase Bitcoin. If you understand the technology, if you can secure it properly using hardware wallets or other custody methods that give you control of private keys, Bitcoin is the digital equivalent of gold. It's more volatile than gold. Price swings are larger. Mood swings of the market affect it more dramatically. But the upside is substantially larger. If the US government revalues Bitcoin to $1 million, your returns are proportionally massive. Start with $1,000 minimum if that's accessible to you. Scale upward based on risk tolerance. The target allocation is 5 to 15% of net worth in Bitcoin. If you have $500,000 net worth, target $25,000 to $75,000 in Bitcoin by 2027. But only if you understand it. Only if you can secure it properly. Only if losing that money wouldn't destroy your life situation. Week 3. Evaluate your bond holdings. Sell all long-term government bonds. All of them. Sell corporate bonds unless they're very short duration, due within months. Bonds denominated in dollars will lose 70% of their purchasing power in real terms. You're holding assets that will become nearly worthless. Move the proceeds. Don't sit in cash. Move them into hard assets. Gold, Bitcoin, real estate, commodities, short-term instruments, money market funds, short-term treasury bills due in weeks or months are acceptable because they mature before the revaluation occurs. You get your principal back in dollars, which you then convert to hard assets. Week 4. Evaluate your cash holdings. Holding excessive cash denominated in dollars is holding a depreciating asset. You need cash reserves for operational expenses, 3 months of living expenses minimum for emergencies, for unexpected expenses, for flexibility. Beyond that, holding cash is a mistake. Move excess cash into hard assets. If you have $100,000 in savings, keep $25,000 as operational cash reserves. Move the remaining $75,000 into gold, Bitcoin, real estate, anything with intrinsic value, or the ability to appreciate. Month 2. Diversify internationally. This is critical. Your wealth shouldn't be entirely exposed to the dollar collapse. Open accounts in foreign banks, Switzerland, Singapore, Norway, other countries with low debt, strong fundamentals, stable currencies. Hold balances in Swiss francs, Singapore dollars, Norwegian krone. These currencies are backed by countries with superior fiscal situations, lower debt to GDP ratios, stronger balance sheets. When the dollar collapses, these currencies appreciate in relative terms. Buy foreign real estate, property in countries that aren't destroying their currencies, that aren't experiencing debt crises requiring currency devaluation. Consider foreign stock exposure, companies that earn revenue in non-dollar currencies, that have geographic diversification. The goal is to prevent total exposure to dollar collapse. When the dollar loses 70% of value, you want wealth in other jurisdictions, other currencies, other assets. Month 3. Build skills and relationships. When currencies collapse, and this has happened repeatedly, what matters most is what you can do, what you can produce, who you know, your network, relationships with people who have resources. Trades are valuable. Plumbing, electrical, construction, carpentry, mechanical skills. Medical skills are irreplaceable. Agricultural knowledge matters profoundly when supply chains break. Repair skills, any ability to fix, maintain, construct things, are valuable. Relationships with people who have resources, land, food, tools, knowledge, are insurance against complete collapse. Community resilience matters more than cash reserves when currencies fail. This isn't doomsday prepping paranoia. History shows currency collapse creates social instability. Having skills and relationships is genuine insurance. Now let me address the objection I know you're thinking. This sounds like doomsday prepping. This sounds like tinfoil hat conspiracy thinking. This sounds detached from reality. Let me show you why it's not. The US debt to GDP ratio is 132%. That's not an opinion. That's published government data. The annual interest payment is $1.2 trillion. That's not speculation. That's Treasury Department budget data. The government cannot pay this through traditional taxation or spending cuts. This is mathematical reality, not opinion. Devaluation is the only mechanism that solves unpayable debt. This is historical precedent. Every government facing this situation has chosen devaluation. The US did it in 1933. Argentina did it repeatedly. Venezuela did it. Zimbabwe did it. When governments have unpayable debt and must choose between default and devaluation, they choose devaluation every single time. The US will do it again. The only questions are when and how. And I've shown you the how. Bitcoin and gold revaluation. I've shown you the when. 2026 to 2027, possibly extending into 2028. The timeline is visible in public policy, in legislation, in executive orders. This isn't conspiracy. This is policy. Visible policy. You just have to look. Here's the final evidence that completes the picture. The world's central banks are preparing. They're acquiring gold at record rates. In 2022 and 2023, central banks globally bought over 2,000 tons of gold, the highest volumes since 1950. These aren't casual purchases. These institutions have intelligence agencies, economic advisors, classified information, inside understanding of what's coming. They're diversifying out of dollars. They're preparing for reset. China is accumulating Bitcoin through state-owned enterprises and mining operations. They're positioning. Russia is stockpiling gold and reducing dollar reserves. They're preparing. The BRICS nations are creating alternative payment systems. They're building infrastructure for a post-dollar world. Every major government with resources is preparing for the identical reset. If they're preparing, why aren't you? They have information you don't have. They have resources you don't have, but you have time. You have the ability to position yourself. Use that time now. Let me show you the timeline one final time, because this is the critical information that determines your outcome. 2025, accumulation phase. The US quietly acquires Bitcoin. Central banks continue gold accumulation. The narrative builds around gold backing and sound money principles. You should be accumulating too. Gold, Bitcoin, hard assets. This is your window. Your opportunity is closing, but it's still open. 2026, crisis phase. The debt ceiling fight becomes severe. Bond market stress emerges. The government needs justification for extraordinary measures. Volatility spikes. Prices fluctuate. Stay the course. Don't panic. Sell hard assets when prices move downward. Don't let volatility destroy your positioning. 2027, revaluation phase. Bitcoin revalued to $1 million. Gold revalued to $20,000. The dollar collapses. Inflation explodes. If you positioned in 2025, you survive with your wealth intact. If you didn't, you're destroyed. 2028 to 2030, stabilization phase. New prices stabilize. Bitcoin settles at $500,000 to $800,000. Gold settles at $15,000 to $18,000. The dollar stabilizes at a new, lower purchasing power. The reset is complete. Those who held hard assets preserved wealth. Those who held dollars lost 70%. The wealth gap explodes. The middle class shrinks. The only question is which side you're on. Here's what the government won't tell you. This reset is intentional. It's not an accident. It's not a market failure. It's not an unintended consequence. It's policy. Deliberate policy to eliminate debt by destroying the currency. They're choosing this because the alternative is default, and default would destroy the government's credibility permanently. Default says the government cannot pay its obligations. Devaluation destroys the people's wealth, but preserves the government's power. The government will always choose devaluation. Always. Without exception. And they're choosing it now. The strategic Bitcoin reserve is not about innovation. It's about creating an asset to revalue. The gold-backed dollar talk is not about sound money restoration. It's about justifying gold revaluation. Every policy move is setting up the reset. Every legislative action is establishing the framework. Every executive order is providing operational authority. You're the collateral damage unless you position yourself correctly. Your action plan spans months, not years. Week 1, precious metals account, physical gold. Week 2, Bitcoin account, Bitcoin acquisition. Week 3, evaluate and sell bonds. Week 4, evaluate and minimize cash holdings. Month 2, international diversification, foreign accounts, foreign real estate, foreign stocks. Month 3, build skills, develop community relationships, establish networks. This is your framework. Week by week, step by step, not delayed, not postponed, not next year, now. The window is closing. Let me address the final dimension, the moral element. Some of you are thinking this isn't fair. It's not right. It's not just. You're absolutely correct. It's theft. It's legal theft. It's confiscation with policy backing. But it's happening whether it's fair or not. You can be morally outraged and financially destroyed, standing on principle while your life savings evaporate, while your retirement vaporizes, while your children's inheritance disappears. Or you can be morally aware and financially positioned. You can understand the injustice while protecting yourself and your family from the worst outcomes. You can survive and fight another day with resources intact. The government doesn't care about your principles. They care about their institutional survival, and they will sacrifice you without hesitation, without remorse, without acknowledgement. That's the reality of power. Your choice is binary. Adapt or get destroyed. Position yourself in hard assets. Preserve your wealth through the reset. Use that preserved wealth to build something better on the other side, to reconstruct, to create, to contribute. Or hold dollars. Believe the government's narrative. Trust that they're looking out for you. Watch your life savings evaporate. Watch your retirement disappear. Watch your children inherit a destroyed currency and a destroyed economy. I know which choice I'm making. I know which choice the people with resources and inside information are making. The only question remaining is which choice you'll make. Before we close, if this timeline shifted how you see everything, how you understand your financial situation, how you comprehend the next decade, don't absorb this information alone. Join our community. People who understand what's happening, who are tracking the signals, who are positioning themselves. Here on this channel, we're monitoring this reset in real time. We're analyzing the policy moves as they execute, the price movements as they materialize, the timeline progression as it advances. We're breaking down what to watch, what the signals mean, how they connect to the larger mechanism. If you want to understand what's actually happening beneath the surface, if you want to see the pattern before it completes, follow this channel. Because over the next 2 years, this reset will unfold exactly as I've outlined. The policy moves will occur. The prices will respond. The timeline will progress. You need to see it coming. It's the difference between preserving what you've built and losing everything. Nothing I've shared is financial advice. Conduct your own research. Make your own decisions. But don't let this information disappear. Share this with everyone you know who holds savings, who maintains retirement accounts, who relies on dollars. Share it with your family, your friends, your colleagues. They need to understand the 2027 reset is coming. The US government is using Bitcoin and gold to erase $37 trillion in debt, and they're using your purchasing power to do it. The more people who understand this before it happens, the more people who can position themselves, the more resilient your entire network becomes. Position yourself now. Share this knowledge now. While there's still time, the choice is yours.